Hi all, welcome to this session. So in this today's session, we are going to cover some of MCQ multiple choice questions from the financial statement analysis part. In the previous discussion, we already covered the key concept of financial statement analysis like ratio analysis and many other various concepts. So in this today session, we are going to cover some MCQ multiple choice question. So you can practice the question yourself so you can become more competent in this area. The other thing, practicing more question is very important, very crucial to success to passing in CMA USA examination, because as we know, it is 100 multiple choice questions are there in the exam window. Once you completed this window successfully, then only you will able to answer or you will able to open the essay session. So it is very important to practice as much as question as possible with the stipulated time frame to ensure that you are very confident to attend the examination. So we'll move into the questions. So this is our first question. Question number 1. A company reports the following financial data. Total revenue 1.2 million. Operating expenses 850,000. Owner salary, that is in market values 120,000. And foregone interest on capital, that is 30,000. What are the accounting profit and economic profit for these companies? You have 4 options here. Option A, B, C, D. So here what we asked, it is accounting profit and economic profit. We already discussed about accounting profit and economic profit in the previous discussion. So let's try to calculate the accounting profit and economic profit. So the first thing, this total, the accounting profit is 1,200. That is 1.2 million divided by, minus 850,000. 350,000. So it's very clear, accounting profit is all the expenses minus total revenue minus operating expenses, that is explicit expenses. So the accounting profit is 350,000. So here accounting profit is 350,000 is already mentioned in the options, that is option A and option B. So I'll write here accounting profit 350. So let's move into economic profit. Economic profit, what is mean is considering the all opportunity cost of the capital aspect. So the accounting profit, what we can say, it is 350,000. Then what you have to minus the owner salary, that is a market value. Then foregone interest on capital, that is 30,000, that is 200,000. So here the economic profit is 200,000. So here the option A is correct. So let's move into its, I have given its explanation here, so you can read the explanation. So here the accounting profit is 350,000, that is total revenue minus all operating expenses, explicit operating expenses. Then the economic profit, that is accounting profit minus all opportunity costs. So let's move into next question. A company has a current ratio of 2.5 and a quick ratio of 0.8. The company has a large amount of short-term debt due next month. Which of the following is the most accurate conclusion an analyst can draw from these ratios? A company's current ratio, that is current asset divided by current liability, it is 2.5. And the quick ratio, quick asset divided by current liability, it is 0.8. So what is the conclusion from these ratios? The first thing, the company is highly liquid and will not have trouble meeting short-term obligation. That is first option. And second option, the company leaves likely a high level of inventory or slow-moving stock. That is second option. Third option, a company's account receivable turnover likely too high. And the fourth option, the company is using financial leverage effectively to increase shareholders' return. So first of all, just try to answer yourself. So here the most suitable option is option B. This is the most suitable option. That means the company has high level of inventory of slow moving item. You see the big gap between the current ratio and quick ratio. This gap is mainly inventory. So from the current asset to quick asset, what we are eliminating, it is inventory and prepaid expenses. So in this case, it is a big gap is there. So it is the inventory. We can assume that it is an inventory. So in this question, the option B is the right answer. So I have given the explanation here in the next page. You can read the explanation. Move to the next question, question number 3. The company currently has a current ratio of 1.5. The company decided to use some of its cash to pay off a portion of its long-term debt, and it is not due within current year. What will be the immediate effect of this transaction on current ratio? So, company has the current ratio is 1.5, and company decided to use some of its cash to pay the long-term debt. So, what will be the impact of in the current ratio? So, before checking the impact, what we have to note, it is the formula for current ratio, that is current asset divided by current liability. So, basically, if we pay the cash, the current asset will come down. That cash is from the current asset, so it will decrease. And definitely in the current liabilities, there is no impact in the current liabilities. So as a result, the current ratio will decrease. So the answer for this question is current ratio will decrease. I have given the explanation for this question. You can read this explanation. So let's move to the next question. Question number 4. Using the following data, calculate the return on asset using the average total asset. Here already given net income, total asset beginning of the year, total asset ending of the end of the year. So this is a straightforward question. You can directly apply the formula in this question. So the formula is net income, that is 120 divided by average total asset, that is 800,000 plus 1.2 million. That means 120 divided by 2. You have to calculate the average, that is 1 million. So that means 120 divided by 1 million, that is 12%. So this is the answer for this question, that is 12%. So first of all, before answering this question, we should know how to calculate the return on asset. So return on asset is net income divided by average total asset. Here the beginning asset and ending asset already given. So from that you can calculate the average total asset. So here I already given the answer and explanation for this question. So let's move to next question, question number 5. The following information is taken from the financial record of a retail corporation for the fiscal year just ended. Credit sales 2.4 million. Total sales including cash sale, it is 3 million. Cost of goods sold 1.8 million. Account receivable in the beginning, it is 180,000. Account receivable in the beginning, it is 220,000. Inventory on 31st December, it is 400,000. Based on the 360 days here, what is the company's average collection period? So you have to calculate the average company's collection period. So what is the formula for collection period? Collection period is 365 divided by account receivable turnover ratio. So the first thing, or in this example, you can take 360. So first you have to calculate the account receivable turnover ratio. Account receivable turnover ratio, what is the formula for total credit sales? Credit sales divided by average account receivable. So you see the credit sale, it is 2.4 million. And the average account receivable, the beginning account receivable is 180,000 and the ending account receivable is 220,000. So you have to average it out. So the average will be 200,000. So it is 200,000. So that means 2.4 million divided by 200,000, that is 12. So 12 is the average account receivable turnover ratio. So you have to apply this account receivable turnover ratio in this formula, that is 360 divided by 12. Let me use my calculator. 360 divided by 12. That is 30 days. So this is exactly in the option itself, 30 days. So this is a direct question exactly. But you have to know exactly what is the formula for this calculation. The average collection period. Average collection period formula is 365 divided by account receivable turnover ratio. And you have to should be able to calculate the account receivable turnover ratio, that is credit sales divided by average account receivable. All the data are directly given in the questions. So it is very easy. So this is the answer and explanation for these questions. So let's move into question number 6. A company is performing a vertical common size analysis on its income statement for the last 2 years. You are given the following data. Already given the sales for the year 1 and year 2. Again, the cost of goods sold for year 1 and year 2. Operating expenses for year 1 and year 2. Based on the vertical common size analysis, which of the following statement is true? The first statement, the gross profit margin improved by 5% in year 2. Then the operating expenses ratio increased in year 2. Then the gross profit margin deteriorated by 5% in year 2. Then the net profit margin remained constant at 20% across both years. So you have to calculate the follow true statement from this fourth statement. So first of all, we will start with the gross profit margin. So in the first example, the cost of goods sold is 600,000 and sales is 1 million. So it is the 400,000 is the gross profit and 1 million is the sales. So that means 40% is gross profit margin in first year. And the second year, first you have to calculate your gross profit, 975. So 525 is your gross profit and the margin divided by 1.5, that is 35,000. So this is gross profit margin. 40% is the gross profit margin in the first year and 35% in the second year. So let's come into first statement, that is gross profit margin improved by 5% in year 2. So that is a wrong statement. It is decreased by 5%. So we'll move to second statement, that is the operating expense ratio increased in year 2. So let's calculate the operating expense ratio for year 1 and year 2. For the year 1, it is 200,000 divided by 1 million, that is 20%. And in the year 2, it is 300,000 divided by 1.5 million, that is 20%. So it is almost same. So the operating expense ratio in this case it is same, so it is not increased. So the statement 2 is wrong. So let's move into statement 3. Gross profit margin deteriorated by 5% in year 2. So that is a true statement. We already calculated the gross profit margin here. So it is 5% reduced in year 2 compared to year 1. So in this case, the correct answer is option C. That is, gross profit margin is decreased by 5% in year 2. So I already given the answer and explanation here in the next page. So let's move into next question. A company has the following financial data for the year, that is net income 500,000, depreciation expense 880,000, increase in account receivable 40%, 40,000, decrease in inventory 20,000, increase in account payable 10,000, capital expenditure 150,000 and dividend paid 50,000. What is the company's cash flow to capital expenditure ratio? So the formula for cash flow to capital expenditure, that is operating cash flow divided by capital expenditure. Capital expenditure. So the capital expenditure is already given, that is 150,000. So what you have to calculate your operating cash flow, you have to calculate your operating cash flow. So from this given example, how we can calculate the operating cash flow? So let me take my calculator. So we can calculate the operating cash flow from the indirect method of preparing statement of cash flow. So we can start with the net income, that is 500,000, plus definitely you have to add back the depreciation and the increase in account receivable. So you have to see what is the impact of increase in account receivable in the statement of cash flow. So increase in account receivable, it is an increase in the current asset. So definitely there will be a negative impact that you have to reduce. Then the decrease in inventory. Decrease in inventory is a decrease in current assets. So definitely there would be a positive impact. So you have to add back that. And the increase in account payable. Account payable is a current liability. If there is an increase in account payable, definitely it should be added. So it is 570,000. 570,000. So let's calculate the ratio, that is 570 divided by 150. That is 3.8. So the option B, 3.8 is correct. So the cash flow to capital expenditure ratio. First you have to calculate the operating cash flow and divided that by the capital expenditure. Cash flow to capital expenditure ratio is telling you how many times you can cover up your capital expenditure by using your own operating cash flow. So here I already given the answer and explanation in the next page. So let's move into question number 8. A company has cost of goods sold is 1.2 million and an average inventory of 200,000. The company is considering a new inventory system that will increase the inventory turnover ratio to 8 times while keeping cost of goods sold the same. What will be the impact of average inventory balance if the new system is implemented? So here the inventory turnover ratio already given. So what is the formula for inventory turnover ratio? That is 1.2 million divided by the inventory at what you have to calculate, and it is 8. So you can apply the formula here, that is the required inventory is 1.2 million divided by 8, that is 1.2 million divided by 8, that is 150,000. So in this example it is 150,000 is the average inventory. So the current inventory is 200,000. So what will be the change? The question is asking what will be the changes in the average inventory. So that means the average inventory will decrease 50,000. So the exact option already given in the exact answer already given in the option. So the option B, average inventory will decrease by 50,000. So here same, I already given the answer and explanation in the next page. So let's move into next question. A construction company switched from a completed contract method to the percentage of completion method for its long-term projects. In the first year of the change, the company reported significant higher net income even though its cash collection remained the same. How you should interpret these terms of earning quality? In terms of earning quality, earning quality has increased because the company is now using more standard accounting method. That is first option. And the second option, earning quality has decreased because the reported income is now more dependent on management estimate. That is second option. Third option, earning quality is unchanged because the both method are gap compliance. Option D, persistence has increased because income is now recognized more smoothly over time. So as a analyst, how you will analyze this situation? So as we know, once we changed the accounting method or revenue recognition method from percentage of completion. Before it was completed contract method. Now it is changed to percentage of completion method. As we know the percentage of completion method, the management will have a room to estimate its revenue. Maybe it is completely recognized or completely earned. Again, in this case, it is already mentioned that the revenue is not supported by the cash flow. So that means the cash flow is remain always similar to previous year, but only the net income is increased when compared to previous year. So definitely there will be an issue with earning quality. So the earning quality has decreased because the reported income is now more dependent on management estimate. That means the earning quality is now decreased because the reported income is now more dependent on management estimate. The management can estimate what is the percentage of completion in this case. Again, it is already mentioned that the net income is not supporting by the cash flow or cash collection. Cash collection, even the net income is increased, the cash collection still remains same as before. So there will be some issue with the earning quality in this case. So option B is the right answer. So I already given the answer and explanation for this question. So let's move into question number 10. A company has the following cost structure. Variable cost is 60% of sales. Fixed operating cost that 300,000. Current sales 1 million. If the company sales increased by 10%, by what percent will the operating income will increase? The first thing what we have to estimate what is the current operating income. So in this case, it is the current sales is 1 million. Then you have to divide your variable cost, that is 600,000, that is 60%. This is your contribution. And the fixed operating cost is 300,000. So the current operating income is 100,000. So let's move into the calculate the second case, that is if the company sales increased by 10%. So in this case the sales is 1.1 million divided by your cost of goods sold is 60% of 1.1 million into 0.6, 660,000. So 1.1 million divided by 660, that is 440,000 is your contribution margin. Then you have to reduce your fixed operating expenses. 440 divided by minus 300,000, that is 140,000. So previously it was 100,000. Now it is changed to 140,000. So that is a 40% change. From 100 to 140,000, that is a 40% increase. So the exact answer is already given as option, that is 40,000, 40%. Again, I already given the answer and explanation for this question as well. You can read the same. So this is about today's session. So we just discussed the 10 multiple choice question that is very related to financial statement analysis part. So again, as you know, it is very important to practice the questions as much as possible. So you should practice as much as questions as you possible before you attend the exam. So definitely that will improve your confidence, and also you should try to practice the questions within the stipulated time frames. So thank you for watching this video. Have a nice day.